Right now, as we speak on this trading floor, Lithium Americas Corp, ticker symbol LAC, is changing hands at exactly $4.73 per share. The intraday action has been tight, chopping within a narrow range between a low of $4.67 and a high of $4.87, currently sitting down roughly 0.21% for the session. The market is hesitating. You can see it in the volume. Buyers are stepping in cautiously at the lows, but sellers are capping every attempt to break higher. This price action screams indecision. Most retail traders looking at this chart see a stock that has been dead weight in their portfolio for months, a company burning cash with no revenue, just digging holes in the Nevada desert while the spot price of lithium carbonate fluctuates wildly in China. That is the expectation. The narrative on the street is that the lithium boom is on pause, that EV demand is cooling, and that LAC is just another speculative mining play that might dilute you before they ever pull a single ounce of battery-grade material out of the ground. That is what the average investor believes. But the reality is entirely different and, frankly, much more aggressive. What we are witnessing right now at this $4.73 level is not stagnation. It is a calculated accumulation phase driven by a massive geopolitical disconnect. While the retail crowd worries about next quarter's earnings, which by the way will be non-existent because there are pre-revenue, the smart capital is looking at the ink drying on the Department of Energy's loan papers. The expectation is that this is a mining trade. The reality is that Lithium Americas has effectively become a semi-sovereign asset, a government-backed security play disguised as a mid-cap miner. When the U.S. government hands you a checkbook for over $2 billion, they are not just investing in a mine. They are securing a national interest. The disconnect between that massive strategic value and the current sub-$5 stock price is where the opportunity lies. And that is what we are going to tear apart today. Let's look at the immediate catalyst that everyone seems to be underestimating. The company just received its first drawdown of $435 million from the Department of Energy's Advanced Technology Vehicles Manufacturing Loan Program. This is not just a press release headline. This is the bloodline of the project. For months, the bears argued that the conditions to access this capital were too strict, that the project would stall, or that management would have to issue massive amounts of equity to fund the gap, crushing shareholders in the process. The reality has now shattered that bearish thesis. The funds are flowing. The machinery is being paid for. The construction at Thacker Pass is no longer a proposal. It is an active industrial operation. This $435 million tranche is part of a larger $2.26 billion package that essentially de-risks the construction phase. When you buy Tesla stock or look at NVIDIA stock, you are paying a premium for future growth that is already priced in. With LAC, the market is pricing in a risk of failure that the U.S. government has explicitly stepped in to prevent. This brings us to the broader market environment. Investors often ask about online investing trends or look for investment help on platforms like Schwab Intelligent Portfolios, trying to find the next big breakout. But they often miss the forest for the trees. The lithium market has been battered. Prices for lithium carbonate in China dropped significantly over the last year, creating a washout in sentiment. However, we are seeing signs of a bottom. Chinese production from lepidolite, a low-grade, high-cost source of lithium, is being curtailed because it is simply too expensive to produce at current spot prices. This is putting a natural floor under the market. When the high-cost supply shuts off, the market tightens. Lithium Americas doesn't need lithium to be at $80,000 a ton to work. They just need it to be stable, and the current shakeout is removing the weak hands from the global supply chain. We need to talk about the 800-pound gorilla in the room, General Motors. This is not just a standard offtake agreement where a car company promises to buy some product in 5 years. GM is a major shareholder. They have skin in the game. General Motors has explicitly stated their intention to secure a North American supply chain, moving away from reliance on Chinese processing. When you see news about GM instructing suppliers to exit China or diversify their supply chains, you have to ask yourself, where are they going to get the lithium? They're not going to get it from Australia and ship it to China for processing if the goal is decoupling. They're going to get it from Nevada. Thacker Pass is the linchpin of GM's EV strategy. Without this mine, their ability to claim tax credits under the Inflation Reduction Act becomes incredibly difficult. So when you hold LAC, you are not just holding a mine, you are holding a call option on GM's entire electric future. Let's pause for a second. I want to hear from you. Comment below how many shares of Lithium Americas you currently hold and what is your average cost basis. Are you underwater from the highs or are you buying this dip? Let's get a gauge of the sentiment in the room. Now, let's look closer at the asset itself. Thacker Pass is unique. It is not a brine operation like you see in South America with SQM, and it is not a hard rock spodumene mine like in Australia. It is a clay resource. Historically, clay has been harder to process, which was a major point of skepticism. Critics said, nobody has done clay at this scale. That was the expectation, technological risk. The reality is that they have spent years running pilot plants, and the process they are using is actually based on well-understood chemical engineering principles, just applied to a new feedstock. The DOE's engineers spent months scrubbing this plan before they approved the loan. Do you think the Department of Energy would commit $2.26 billion of taxpayer capital to a science experiment that might not work? No, their due diligence was likely more thorough than any Wall Street analyst's report. The validation from the DOE is the ultimate stamp of approval on the technical feasibility of extracting lithium from clay at Thacker Pass. If we zoom out to the competitive landscape, you have many options for self-investing. You can use a Fidelity trading platform or open a Robinhood stock trading account and buy ETFs. You can look at Albemarle or speculative juniors in Canada. But notice the difference in capital structure. Most juniors are starving for cash. They are constantly raising funds, diluting you, just to keep the lights on. LAC has the cash. Between the GM investment and the DOE loan, their funding gap is manageable. They are fully permitted. They are under construction. They are years ahead of the peer group. While other companies are still fighting in court for permits or drilling test holes, LAC is pouring concrete. In the mining game, the gap between shovel-ready and actually building is where the value creation happens, and LAC has crossed that bridge. Let's analyze the intraday volatility we are seeing today again. The stock is pinned near $4.73. This level acts as a pivot. Technical traders using interactive brokers workstations will see that $4.50 has established itself as a massive support wall. Every time the stock dips near there, volume spikes and the price wicks back up. This tells us that institutions are defending that level. On the upside, $5.50 to $6 is the resistance band. We need to see a high volume break above that zone to confirm a trend reversal. But for the long-term investor, this consolidation is healthy. It builds a base. It allows the moving averages to flatten out and turn up. If you are using SoFi Invest or managing your Fidelity Wealth Management account, you know that buying during these boring sideways consolidation periods is often where the best risk-reward ratios are found. You're not chasing a green candle, you are positioning before the breakout. There is a geopolitical angle here that we cannot ignore. The United States government has realized it is perilously behind in the battery arms race. China controls the vast majority of global lithium processing. If tensions escalate and we see trade wars or tariffs ramping up, access to refined lithium could become a weapon. In that scenario, a domestic source like Thacker Pass becomes a national security asset. It wouldn't just be about the price of lithium, it would be about the ability to build anything. This premium is not currently priced into the stock. The market is pricing LAC like a generic commodity producer, not a strategic defense asset. This mispricing is the alpha we are hunting. Consider the construction timeline. Mechanical completion is targeted for 2027. Production ramps in 2028. This sounds far away. In the world of Robinhood cash management and instant gratification, 3 years feels like a lifetime. But the market looks forward. Typically, mining stocks get re-rated about 12 to 18 months before first production as the execution risk diminishes. We are approaching that window. As the steel goes up and the concrete is poured, the risk discount applied to the stock price will shrink, and the value will naturally drift higher toward the net asset value of the project. We aren't waiting for 2028 to see gains. The repricing happens as the milestones are met in 2025 and 2026. We should also discuss the risks, because no analysis is complete without them. The biggest risk is not the lithium price. LAC can survive lower prices better than most. But execution. Building a multi-billion-dollar chemical plant in the desert is hard. There could be cost overruns. There could be delays. We have seen this with almost every major mining project in history. However, the structure of the DOE loan provides a buffer. The partnership with Bechtel, one of the largest construction firms in the world, adds a layer of professional management that a small junior miner wouldn't have. They aren't trying to build this themselves with a few contractors. They have brought in the heavy hitters. Investors interested in investment individual brokerage accounts often ask about the exit strategy. For LAC, the exit strategy is simply cash flow. Once this mine is running, it will be a cash cow. The operating cost for lithium sedimentary deposits can be competitive, and once the capital expenditure is paid off, the margins are significant. Or there is the M&A possibility. In a world where big oil and big tech are starting to look at mining,